Hello, my name is Mike Acton. I'm the head of research for AEW Capital Management in the United States. AEW is an investment manager who specializes in real estate only. We've been in business since 1981, so celebrating our 40th anniversary this year. And we invest across the entire equity spectrum, all the way from core strategies up through opportunistic. We also invest in actively managed real estate securities portfolios. And we also are a direct lender in property. Yeah, the cash flow characteristics of essential housing investment flow directly from the occupancy and operational characteristics of the properties. And what I mean by that is these properties stay extremely well occupied. Tenants here, as I said earlier, do not give up their unit easily. It's very difficult to move. Typically, these residents would have challenges moving simply because of the deposits, first months, last months, that sort of thing, as well as the search costs of finding another unit. So these units stay very well occupied. The tenants are very mindful to stay current on rent and things like that, because they don't want to lose this unit if it's well managed and it's where they need to be locationally, close to jobs, close to schools, that sort of thing. So by not turning the units over very frequently, the operator, the landlord, owner of the property doesn't have the costs that are typically associated with changing tenants. When a tenant moves out of an apartment, you typically have to do some things to the unit, new paint, new carpets, things like that. Those costs get held down. And because they're so well occupied, the cash flow of the properties is very, very stable. So these are very attractive to investors. They're very attractive to lenders. They lend themselves very well to supporting debt service on properties and so on. It's a part of the market, though, that historically has largely been ignored by institutional investors. In the past, most institutional capital that's gone into this segment of the market has gone in with the explicit intention to change the nature of the unit to something else other than the unit being affordable to low to moderate income households. And what I mean by that is the money usually comes in some sort of what we refer to in the industry as a value-added strategy. Go in, update the units, change the configuration in some way in an attempt to raise the rents. And when you do that, of course, investors can make good profits doing that. But there's a consequence to that, particularly to the people that are currently occupying those units. They get displaced. They are forced to leave in most cases. And as I said earlier, there's not a lot of other places for them to go in the same community. So that creates ripples, if you will, throughout not just that family, that household, but ripples throughout the community as well. So what we're trying to do is to make the investment returns that our clients need. That's the paramount goal of our investment strategy, to achieve the investment goals of our investors. But we're trying to do it in a way that minimizes those negative externalities and, to the extent possible, accentuate any positive externalities that might come from providing and maintaining stable, affordable housing. And those could be outcomes related to education attainment, job growth, advancement, just on a personal level for the residents. The only thing I guess I would add is, most of our investors historically have invested in really the Class A segment of the market, the very high end. And what's interesting about that is because that's where all the investment goes. That's where all of the new supply comes in. So to the extent that you have sort of a cycle in housing, because supply gets ahead of demand and, occupancy rates drop and rents soften, that happens almost exclusively only in the A segment. It doesn't really happen in this other segment of the market. It's sort of counterintuitive to a lot of our investors because they've been conditioned, and we're as guilty as anyone. They've been conditioned to think that they should be investing in the bright, shiny new thing in the rental market, and there's certainly a place for that, of course, in anyone's investment portfolio. But for the most part, they haven't really thought much about this other portion of the market, which is just much, much larger, much more liquid. So I think that's an interesting thing to point out to them. So the pandemic has been a very disruptive event for many, many aspects of the property market. And that is certainly true for the essential housing segment in certain regards. In a very large regard, the essential housing market really hasn't changed at all. There's still a structural imbalance of 7 to 8 million units. Almost every place in the country, there's not enough of the type of housing that we're talking about at the price points that are affordable to low to moderate income households. But the pandemic has done a lot of things that have direct and indirect implications for the essential housing segment of the market. One thing it's done is it's put a lot of people in the United States in motion. You've seen anecdotally, but now you're starting to see in actual data, the movement of people from cities to suburbs, from high-cost markets to lower-cost markets, people moving, say, from the Bay Area to Austin, Texas, as an example. Those things were happening before the pandemic, but of course the pandemic has accelerated a lot of that, maybe pulled forward a year or two of those types of movements. People say, well, so what? That's happening everywhere. What does it have to do with essential housing? Well, what it does is when people move, we'll just use the Bay Area to Austin as an example. When people move from the Bay Area to Austin, Texas, they come in with a mindset to pay rents that would seem low in the Bay Area, probably seem high in the Austin market, and they come into the rental market, they take units, and they displace people who are currently in those, who are then forced to move down into the next price segment of the market, and so on. And that eventually ripples all the way down into the essential housing segment of the market, the places where the rents were previously affordable to low to moderate income households. But now there's new price pressure in the market from these people coming in from higher income, higher rent markets, impacting that directly. The other place that has also been accelerated is the movement of people from rental housing into single family housing. We've seen a surge in home sales and a surge in home prices. So at first blush, you might look at that and you might say, well, that's good, right? That's freeing up some rental units for the essential tenants. Well, it doesn't really work that way. When housing prices go up in a metro area, the rents in that metro area go up as well. One, it creates a larger group of people that probably simply can't afford to move into the single family market. But when home prices move up, it creates space for rents, at least at the highest end of the market, to move up as well. And eventually those higher rents cascade down through the rental stock, forcing the rents in the segment of the market we're talking about today, the essential housing segment, to also have to respond and move upward. So it doesn't really help the tenants that we're talking about. And that has been pulled forward probably a year or two as well. Just a large chunk of people that were probably thinking about getting into the housing market over the next couple of years probably fast forwarded the decision and moved over the last year. So the pandemic's had a lot of impacts. And of course, it's had a really big impact on the workers themselves. As I said earlier, the people that we're talking about are the people that we now collectively think of as essential workers, the people that actually leave their house every day and go out into the world to provide services that we now also refer to as essential. And this past year has been extremely stressful on these households. And to the extent that any of them have suffered job loss or other misfortune along that way, it does hurt disproportionately to these households because they typically don't have much cushion in their household budget to absorb any sort of income impact as well. Well, the future of the essential housing segment of the rental market is really quite strong from the perspective of our investors. It's going to be a portion of the market that is going to be undersupplied structurally for many years to come. That's not going to go away. And that's been true in the United States for several decades now. It's going to be true for quite a bit of time going forward. As I said earlier, we think the structural imbalance is probably 7 to 8 million units. There's a lot of interest and visibility to this segment of the housing market today that perhaps was aided a bit by the pandemic. We've all had this brought much more into focus for us. And of course, things like the debate around the infrastructure bill, the debate around the expansion of the child tax credit and things like that has brought up a lot of attention to the segment of the housing market that we're talking about, which is good. So there's more resources being brought to bear on this segment. The families and households that are the tenants in this segment of the market are perhaps a bit stronger because of some of these things that are going on legislatively in Washington, D.C. So that's all to the good. But unfortunately, the mismatch, the supply and imbalance is so large that it's going to take a very, very long time to really make a dent in it. So we're very excited about this. We think it's a really good opportunity for our investors. It's a segment of the housing market that is really missing in their portfolios. It provides income characteristics that are really, really hard to find in the capital markets today, really almost anywhere around the globe. So we think there's going to be a lot of interest. We think the investment returns are something that our clients really need, this type of return. And we think it can also have some positive externalities certainly for families, for communities, and if you take it to a logical extension for the country as a whole. It's a really interesting time to be an investor in this portion of the housing market.